Hello again, everyone. This is Joe Hentges with Beyond the Chart. And in this stock market update, I'm going to take a look at the S&P 500 and the New York Composite and check back in on the Gold Miners, GDX, and talk about an indicator on the S&P 500 that is only given this reading once in the last 16 years. And we'll talk about what happened. So stay tuned. All right, let's start off here with the S&P 500 on the daily chart, and you can see on Friday was down 7 points. So now we've closed below this trend line for the second time in the last 4 days. And it looks like it's potentially weakening. The 10-day moving average is still above the 21, but if we get a couple more days below, it's going to pull it back down. Key support here is 21.44 to 45. We break that, I think we're going to come down and test 21.20. If that does not hold, this could quickly turn into a waterfall situation to the downside. All right, so that's that picture. Let's take a look at the S&P 500 on a weekly chart. Now, you notice I'm talking about the ADX equals 9 here, and that's the indicator I'm talking about. ADX is usually an indication, used as an indicator that talks about whether a market is trending or not. A lot of times folks think of ADX greater than 15 and for sure greater than 20 and rising as in a trending mode. The other thing that I've picked up with the ADX and using it over the years is that when it gets extremely low, that many times that's an indication that a big move could be coming, okay? So what happened here on the weekly chart, the S&P 500 for 5 weeks in a row, starting with the week ending August 12th through the week ending September 9th, had a reading of 9, okay? And here we are with the 3 out of the last 5 weeks closing below the 10-week moving average in here. And we've definitely been struggling to make any kind of progress to the upside. And so with 3 out of 5 closing below the 10, we may be starting to pull back, pull down, but we're going to need some continuation to the downside to kind of prove that out. Let me go back and show you the last time we got readings like this at the 9. You got to go all the way back. Look where that line is, that horizontal line. Yep, I missed it. Here we go, right here, September 2000. That's the last time in 16 years that it gave a reading like this. And what happened in September, we had 3 weeks in a row where the ADX equals 9 in September of 2000, and we then lost 46% of our value over the next 24 months, okay? So that's what happened the last time we got a reading this low, especially for several weeks in a row like this. So it's going to be real interesting to see, watching very closely. Do we get some more closes? Do we start to roll on over in here right now? I think we're very vulnerable, so we're watching that very closely. All right, the last thing I just want to point out this week, well, actually, I want to look at the New York Composite because I wanted to point out the contrast in here that we're not sitting at new all-time highs on the New York Composite on a weekly basis. And I feel like the New York Composite gives a better picture of the stock market because it's a much broader picture. There's over 2,000 stocks in the New York Composite. There's 500 in the S&P 500. Okay, so there's over 4 times as many stocks, in this picture, and it gives you a much broader image or a picture of what's going on. And I think the fact that it has struggled to go up and mirror what the S&P 500 did and the Dow did in punching to new highs gives a very weak picture of what's going on. And so now watching very closely here also for this to potentially roll on down over here. Now, we've gotten a couple closes, again, 3 out of the last 5 weeks, closing below the 10. I want to see a couple of weeks in a row, and then especially if this 10 starts to break below the 21-week moving average like it did back up in here. Now, sometimes it does it, and it just waffles around, but again, that's why I put a lot of emphasis on the wave count too. The other thing to point out is look how weak this got in this move down here. It got as low as it did in June of 2013. Let me put this up like this, okay? It got almost to that low. Well, when you look at the S&P 500 on a weekly basis, where's June 2013? Right here. We didn't even come close to being that low in the S&P 500. It just shows you how much weaker this overall stock market picture is, and the broader measures tell a more accurate picture of what's going on. All right, gold miners. We all know how gold and silver got whacked this week, down pretty big. GDX, I just want to point out that, you know, back on August 6th, I created a video where I talked about the fact that I felt like there was 5 waves up. Quote, I think we've got 5 waves up here in GDX, implying that you're going to get a pullback and retracement. I said I think the pullback may come down, maybe pull back down into this 4th wave. And this was the exact labeling I had on the chart. I haven't changed this chart. Okay, so this week we got right back down in near that low, that 4th wave. I am looking here for this to potentially get some support here. If 22 doesn't hold, then this is going to come down and test the 19 to 20 area without a doubt. So that's why it's pretty critical right now. Friday, actually I should have said August 5th. I made the video on the 6th, Saturday the 6th. It closed at $30.22, and so on Friday the 7th, it closed at $23. So pretty significant savings if you'd gotten yourself out the week afterwards. And actually, you could have gotten out that following week because it continued to go up just a little bit, at even a little higher than $30.23. So that's the picture on GDX, and if you want to go back, check out that video on August 6th. All right, if you're watching this video anywhere else but my website, head on over to the website. If you felt the video was helpful, please hit the like button and share the video with your friends and family. All right, everyone, thanks for watching. We'll talk to you on the next video.